When it comes to investing, we all have the same goal: build generational wealth. But how we go about that and attaining those goals could be very different. You could have investors that are more focused on growth and taking more risks. Some investors might want to take more of a hands-off approach and just focus on ETFs. And plenty of us are sitting right in the middle. But regardless of which route you take, it all comes back to having a firm foundation. And the easiest way to diversify your portfolio right out of the gate is through index funds and ETFs. And in today's video, we're going to focus on a simple 4 ETF portfolio. Whether these are the only investments that you make or whether you make this the foundation of your portfolio, all 4 of these ETFs can work together. But before we take a look at them, do me a huge favor. Click that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And as I mentioned, today's video is going to focus on a 4 simple ETF portfolio, beginning with our first ETF, which is the Vanguard S&P 500 ETF, stock ticker VOO. This is what I like to believe should be a staple in any portfolio. After all, the S&P 500 invests in 500 of the highest quality and best companies here in the US. And if you look back over decades upon decades, you cannot find a 20 consecutive year period in the S&P 500 where you would have come out negative. VOO is the ETF that I selected here, but there's a number of different offerings, all of them tracking the S&P 500. You have IVV or even SPY. Although SPY has a higher expense fee, it's better if you're focused on options like I am, trying to generate income each and every month. SPY is one of the most transacted option plays on the market today. However, if you are focusing on long-term, then take that lower expense fee and invest in VOO. It tracks the S&P 500 exactly the same. VOO has assets under management of $1.2 trillion, and over the past 10 years, the S&P 500 has gained 180%. Good for a simple average of 18% per year, which is extremely strong during that period. Typically, the S&P 500, it usually returns on average roughly 8 to 10%. And in fact, the great Warren Buffett is a big believer on centering your portfolio around the S&P 500.
It's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin.
So what are some of the stocks that you get by buying into an S&P 500 fund? Well, it happens to be some of the best in the world. They include the likes of Microsoft, Nvidia, Apple, Amazon, Meta, Alphabet, Berkshire, Eli Lilly, and Broadcom. These top holdings account for 35% of the S&P 500. And in addition, you get exposure to a number of different sectors, although its reliance on technology has certainly grown over the years. The top sectors and their exposure include technology at 33%, financials at 12%, healthcare at 12%, consumer discretionary around 10%, and rounding out the top 5 is communication services at 9%. Definitely a broad ETF, but not as broad as it once was, considering all the sectors on the right side column are at roughly 5% or lower. With VOO, you also get a dividend that currently yields 1.3% with a 5-year dividend growth rate of just 4.4%. Considering there's a lot of growth names at the top of the index that either don't pay a dividend at all or just started paying a small dividend, this doesn't come surprising. So when it comes to the S&P 500, there's a number of different fund options that are available to you. I happen to love VOO for long-term, SPY as it pertains to options. And when it comes to my channel, if you enjoy going through and hearing my take on various different stocks or even ETFs, it's always important though to get insights from other sources as well. And right now you could sign up with the Motley Fool and get their 10 best stocks to buy right now by going easily to fool.com/Mark, and you can check out those stocks right now. And that leads us to our second ETF, which is the Schwab US Large Cap Growth ETF, stock ticker SCHG. Now, we mentioned it with VOO in the S&P 500, how their technology exposure has increased, but it's still rather broad. With SCHG, we're going to ramp up that growth. we're going to ramp up that technology and communication services exposure within this particular ETF. There's going to be a great deal of overlap since we are focusing on large cap and the S&P 500 is a market cap focused ETF, and the overlap right now is right around 45% or so. However, we are focusing by increasing our exposure into some of those top growth focused companies within the S&P 500. So yes, we will still have Apple exposure and Nvidia exposure and Microsoft, but SCHG, that exposure rate is even higher. And just like we mentioned with VOO and the S&P 500, there's a number of different growth-focused options. SCHG is just one of them. Others include the likes of the very popular QQQ, which is a great growth opportunity if you are doing options. QQQM is great for longer term. Or how about VUG, being the Vanguard growth-focused ETF? A number of different options out there. SCHG has assets under management of $30 billion, and over the past 10 years is up 310%, which just speaks to how much these mega cap growth companies have carried the load over the past few years. Without their performance, the S&P 500 would not be up all that much. As you can imagine, being a growth-focused ETF, the largest sectors within this ETF are going to be exposed to both technology and communication services, which happen to be the best two performing sectors over the past few years. Looking here, we could see our sector exposure where technology accounts for 49%, communication services 13%, followed by consumer discretionary at 12%, healthcare at 12%, and financials at 6%. Not much exposure outside of those top 5 sectors at all, really. So as you can imagine, there's many large cap and Mag 7 stocks that are taking up the top holdings with much larger exposure rates than we saw in the S&P 500. Top holdings include Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, Broadcom, Eli Lilly, and Tesla, rounding out the top 10. These top 10 positions make up 59% of the ETF, with half the number of positions than the S&P 500. So as is the case with both of these ETFs we just looked at, these are more geared towards that growth component of your portfolio. And that leads us to the third ETF on our list today, which is the Schwab US Dividend Equity ETF, stock ticker SCHD. And you've heard me talk about SCHD a number of different times in past videos, and you know that this is a favorite dividend of mine. And I've mentioned it from time to time that this is one of the best complements to those growth-heavy ETFs like SCHG or the S&P 500. Why? Because that technology exposure is much lower in SCHD, where it increases exposure to the other sectors that you may not have been getting with those first two funds. Again, when it comes to managing your own portfolio, it's all about having the proper balance. It doesn't mean it needs to be balanced across the board, but being a little bit overweight is okay, not extremely overweight one particular sector. In terms of SCHD as a whole, the ETF has assets under management of $59 billion, and over the past 10 years, shares are up 120%. For much of those 10 years, it was in lockstep with the S&P 500, or even outperforming at times from a total return perspective. But the past few years, it has drastically underperformed given the large move we have seen in technology. After all, SCHD lacks that large exposure to technology and communication services, which is why I mention it being a great complement to those growth-heavy ETFs. The top sectors include financials with 18% exposure, followed by healthcare at 16%, consumer staples at 14%, industrials at 13%, and energy at 12%. Many of these sectors were on the low end of the spectrum for the S&P 500, and as you can see on the right side, technology and communication services account for only 8.6% and 4% respectively. Now let's take a look at the top holdings, which are rebalanced on a quarterly basis. At the top, we see Lockheed Martin, AbbVie, Home Depot, BlackRock, Amgen, Bristol Myers, Coca-Cola, Cisco, and Pfizer. And rounding out the top 10, Texas Instruments. These top 10 holdings account for 40%, and in total, there's 103 total holdings. So as you can see, much more broad in terms of those first two ETFs we saw. And the higher exposure is the least amount of exposure for the most part that we saw with SCHG as well as VOO. But on top of broadening out your portfolio, you also get a very solid dividend, a solid yield, and solid, strong dividend growth. As you can see here, the ETF currently yields a dividend of nearly 3.5%, with a 5-year dividend growth rate of 13% and 12 consecutive years of dividend growth. A lot to like when it comes to SCHD. And that leads us to the last ETF on our 4 ETF portfolio, which is the Vanguard Total Stock Market ETF, stock ticker VTI. Now, when we talked about SCHD, we talked about broadening out, getting more broad. Diversification is key. Well, it doesn't get more broad or well diversified than VTI. VTI invests in every single public company within the US. And I guess you could technically get even more broad than this by investing in VT, which is the Total World Market Index ETF, which that's a little bit too broad for me. I want to focus and have more exposure to the highest quality companies in the US. So although the percentage of this VTI and something like VOO won't be the same, if you're looking for diversification, this is going to be that. VTI currently has assets under management of $1.6 trillion, and over the past 10 years, the ETF is up 167%. This ETF will obviously have crossover amongst all 3 ETFs we've already talked about, given that this ETF invests in every single public company, but the exposure rates come down from that standpoint. Let's first begin by looking at the sector exposure, where the top sectors include technology, financials, healthcare, consumer discretionary, and industrials. In terms of top positions, you will see the same names as you saw with the top S&P 500 for the most part, with Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, Eli Lilly, Broadcom, and Berkshire. In total, VTI has position in over 3,600 stocks, quite a lot, which is why many investors like this ETF to gain that broad exposure. So as you can imagine now with VTI, you get mega caps and large caps, mid caps and small caps, and yes, even micro caps. So for me though, I like that exposure to the US market, which is why I don't invest much in VT. I would prefer something more like VTI. I want more exposure to the highest quality companies here in the US. So there we just looked at a simple 4 ETF portfolio. Let me know what changes that you would make within this portfolio here. Would you add any ETFs or take out any ETFs? I'd love to hear that down in the comment section. If you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.